Joining me now, Upholdings founder and portfolio manager, Robert Cantwell. Your reaction to this quarter from Tesla?
Morning, Megan. Yeah, the Tesla numbers were awesome. I mean, they delivered more than 300,000 cars again in a quarter where interest rates were starting to go up and folks were afraid that inflation was squeezing wallets. And I think a lot of investors were caught off guard that Tesla was still able to deliver that volume of vehicles, but Netflix couldn't deliver the same amount of subscriptions they would have expected. You're talking about a $20 subscription versus a $65,000 sports car. And one of the things that's made Tesla so special has been that instead of putting a lot of money into marketing, they've been able to put all of that money into the product itself. And one of the slides that Tesla shared was all of the discussion around electric vehicles from all their competitors is actually just resulting in more Teslas sold. So the brand is in a really strong position. We're really impressed with the brand they've built. The one thing at the end of the day you still got to be careful about is they're still a car company selling cars. And the economics of that business can only be so good. So you got to be careful about the price you pay.
Right. Keep talking about Netflix, though. So the stock fell 35% yesterday. It's the biggest loss since 2004. It's lost the company nearly 2/3 of its value just this year. In 2022. Billionaire investor Bill Ackman, meantime, sold all of his Netflix stock, which he bought less than 3 months ago, for more than $1 billion. He took a $400 million loss on that. So where does this company go? You want to talk about, again, cars, competitive industry, streaming, competitive industry, but Netflix kind of took its eye off the, screen.
Well, we have a few things to pick apart there. So first, Bill Ackman, and we appreciate, as fellow investors that are extremely transparent about everything that we do, it's great that Bill puts his investment theses out there when he buys something. And he put his investment thesis in his annual letter out there a couple of months ago on Netflix. And frankly, it was a pretty flimsy one. It lacked the level of unit economic depth that we've been accustomed to when Bill Ackman is getting involved in a real estate company or a retailer like Lowe's or Starbucks. And so we think even leading up into the quarter, he was getting a lot of negative feedback on the position that he took as quickly and as aggressively as he took it. And he, rather than doubling down, he said, well, let's just get out of the category and take more time to learn it before we decide whether or not we're going to leave our investors posted here. Now, that said, we suspect that Netflix's share price may have actually been more aggressively hit because of how quickly an investor like that exited. Because it gets around on Wall Street when an investor is dumping like that. And that has an enormous impact on a single day's trading volume, and that could have brought the shares down quite a bit. But the Netflix management team, they've got bigger problems to work through because they've been incredibly stubborn about sticking to a subscription-only plan for all this content. And we've had a small position in Netflix over time. Our biggest hangups with them have been, obviously, the valuation has been high, but they've gotten to a level of content spend that 200 million subscribers is not actually enough viewers for the amount of money that they're spending on content. They're going to spend almost $20 billion in content acquisition in the next 12 months. And 200 million viewers around the world, frankly, is not actually a very big number on that volume of content spend. And so that's why they're getting into the free ad tier. We think it's also likely that they're going to get into licensing their content to other potential channels or even linear television to help get higher returns on their content investment.
Which of the streaming platforms has the best metrics on content spend, and does that make it a buy?
Well, it's really hard to judge all of Netflix's competitors on, because what you'll see from some of the traditional agencies. So Disney, for example, Disney's strategy was to come out and say, we're putting everything we've got available on streaming. And that was dollars that they paid for years ago to build a lot of that content. So it's very challenging to do a dollar for dollar comparison. The one thing that is going to change, and we believe Rich Greenfield over at LightStreet had a great insight on this, at LightShed, excuse me. It was that everyone in the category that has been pushing into streaming has been doing so because Netflix was showing them that this was a 600 or 700 million subscriber opportunity. And for the business to stall out at 200 million subscribers, it's going to change the investment level for all of these competitors that have been entering into the streaming category. And so now we're going to see what happens. Is that going to be a positive for Netflix because you have less competition?
That is a terrific analysis. Robert Cantwell, thank you so much. It was great to see you this morning. We'll see you again very soon, I hope.
Thanks.